Thanks everyone for joining the call. I'm going to be giving this TED Talk on investing in a volatile market. I honestly have about an hour's worth of content that I'm going to try to cram in about 15 minutes or less. So let's jump right in. So I want to start our discussion of risk with the movie The Big Short. I traded on the trading floor for 4 years at Credit Suisse during the subprime meltdown. And while I was not involved in trading any of the subprime securities, I belonged to the same division where they were traded. So I had a lot of exposure to everything going down. The head of that division was a guy by the name of Kareem Sarah-Geldon. And my boss reported to Kareem. So I was just 2 steps away. So let's just take a quick 1-minute view of what happened at the end of this movie after everything imploded.
But at least we're going to see some of them go to jail. Right? I mean, they're going to have to break up the banks. I mean, the party's over.
I don't know. I have a feeling that in a few years, people are going to be doing what they always do when the economy tanks. They will be blaming immigrants and poor people.
But Mark was wrong. In the years that followed, hundreds of bankers and rating agencies executives went to jail. The SEC was completely overhauled, and Congress had no choice but to break up the big banks and regulate the mortgage and derivatives industries. Just kidding. Banks took the money the American people gave them and they used it to pay themselves huge bonuses and lobby the Congress to kill big reform. And then they blamed immigrants and poor people. And this time, even teachers. And when all was said and done, only one single banker went to jail. This poor schmuck, Kareem Sarah-Geldon from Credit Suisse. He hit a few billion in mortgage bond losses, something most of the big banks did on a good day during the crisis.
So Kareem, obviously I knew him very well. He was just a couple steps away. I worked with him regularly. Kareem was hiding losses of $1.8 billion. And while I was not directly involved in trading subprime securities, everyone is impacted by this fallout. And I had significant exposure to the risk and volatility. And that's why I want to talk about this topic today, because it's very important for all of you who are looking to kind of invest and build your own portfolios. So I want to be clear, a get-rich-quick scheme by day trading in the stock market is an illusion. It's about as real as repeatedly winning at the slot machines. That's not a sustainable strategy. But if you want something more sustainable, you can make a lot of money if you learn how to manage risk. So when I say risk, what does that even mean? Like, how is it measured? And it's about losing your money, but can you really quantify that? And the answer to this is yes. Volatility is the most common measurement of risk in the stock market. It's a measure of certainty, and it measures how much the price of a stock whips around using like basic standard deviation. So let's take a look at 2 companies and their volatility over just this past week. Walmart and Tesla. So this is just a single week, and you can see both were up for the week. If we look over 30 days, Walmart has volatility of around 18%. So you look at that purple line at the top, and it kind of it follows it. That's the average, and you can see there's not a lot of movement up and down from that, but you get a feel there is some. And so 18% is where they're at. Over that same time period, Tesla's was 132%. And that type of volatility, it can swing in either direction. So you've got this risk-reward trade-off where the more risk you take, the greater the potential reward. And indeed, if we look since the beginning of the year, Walmart is up 20% year to date, whereas Tesla is up 573%. But the catch in that is it doesn't always play out that way. Tesla could be down that much as well, and that's risk. So this is the point. Risk, i.e. the uncertainty in your return, is measured in volatility. And that is what you have to manage if you're investing in the stock market. So let's peel back this onion and look a little bit deeper, because volatility can be broken into 2 main categories of risk. First is unsystematic risk. This is the risk that takes place at the company level, sometimes called idiosyncratic or specific risk. And it deals with what actually takes place at the company, like management decisions, operations, company sales, etc. The second is systematic risk. And this is the risk that's inherent in the entire market. For example, on any given day, the president can say something and you'll see the whole market move, some more than others, but the entire system is affected. COVID-19 is a perfect example of systematic risk. So why do we split out risk this way? And the reason is because we can't do a lot about systematic risk. There is a lot you can do about unsystematic risk. And a good investment strategy aims to eliminate unsystematic risk through diversification. So you're looking for, in diversification, you're looking for non-correlated assets. And as the two securities move at times in different directions or by different amounts, they start to offset each other, and it has this kind of smoothing effect. So they're going like that, and when you average them out, it kind of smooths it out, and that reduces your volatility. And you want like no less than about 30 stocks in your portfolio to start getting good benefits of offsetting diversification. So in general, this is a massive topic for another day, but suffice to say that diversification isn't just about spreading your eggs across different baskets in case you drop one. It's about mathematically reducing volatility. Even diversifying your investments across different asset classes can reduce some amount of systematic risk. So in summary, the main question you should be asking yourself is, how does the average person like myself who knows little about the market go about diversifying, right? And I'm glad you asked that question, because that's what we're going to go to next. So there are a few options to diversify. Well, I'll just go over a few of them. First, do it yourself. I don't recommend this. You have to have the expertise, and then there's the transaction costs. And because you're not buying in bulk, it's a huge time commitment, and you have to worry about balancing the portfolio. So that's one. The second one is mutual funds. And honestly, mutual funds don't have access to a lot of asset classes, but more importantly, the high expense ratio of mutual funds, it chips away at your return, and it's a substantial impact over a number of years. Index funds are a step up. It's passive, so you have a lower expense ratio, but it still has several limitations, including liquidity, only being able to transact once per day. In other words, there's only one price at the end of every single day called the net asset value, and that's how mutual funds work as well. So they have some limitations, and also they're not quite as tax efficient as this final category, which is ETFs. And these exchange traded funds have become the most popular investment vehicles for both institutions and individual investors. An ETF is like a basket of securities, sometimes hundreds, that trade like a single stock. So it has a ticker, and you buy and sell it just like any stock, but it's a basket. It's like an average of the basket, and it has a single price as if it's one stock. It has the lowest expense ratio, and it's very tax efficient because you aren't churning the portfolio as much as you are like in a mutual fund or an index fund. And finally, with ETFs, you have access to many asset classes that are otherwise difficult to invest in. Here at the bottom, you can see the expense ratio published by Morningstar a few years back, just to get a feel. But I'm personally a big fan of ETFs. They're a very low cost diversification strategy. So the last thing I want to show you as part of my little speech today is how to research and buy ETFs. So I want to take you to one of my favorite sites to research ETFs. It's ETF Database, or etfdb.com, and we're actually going to go there. So over here, what you have is you have a list of all of the ETFs. If we look at this very first one, SPY, this is this is the most popular ETF out there, frequently called spiders for short, but this is the S&P 500. So when you buy a share of this stock or this ETF stock, right, you are in essence investing in the entire S&P 500 index. So you've now bought a small piece of 500 companies with one share. So it's amazing diversification with a single purchase. And you can see year to date, the S&P is up just over 11%. So over here on the left, what we have is we have like all of these filters and slicers. so we can explore and kind of research various different ETFs. You can see in total there's just over 2,300 different types of ETFs. So let's just go play around a little bit and take a look at a few. So let's suppose for a second we're looking and saying, I want to buy an equity ETF. Equity is synonymous with stocks, right? And you can see we can filter further. So first of all, by clicking equity, we've already narrowed it down to now just over 1,500. So the rest are obviously non-equity. And here you can get a feel for different types. So we can look at size, scroll down, we can look at their investment strategy, their region. Let's come down here to sector. There's lots of different sectors. And because we are a tech company, I'm going to come down here and take a look at technology right here. So we're looking at technology. Let's suppose we wanted to go with software. So there's 8 software ETFs. And we click on them and you can get a feel here for some of the different ETFs. Let's pick one right here called Wisdom Tree Cloud Computing. So if I click on this, first of all, you'll see that since the beginning of the year, it's made over 85%, which is just phenomenal. But clearly it's not always going to be that way. So I click on this here and I can see the expense ratio. So it's just under 0.5% for this particular ETF. We can go take a look at the holdings. We can see all these different companies that are in it and what percent of this basket each of these represent. You can see Zoom's in there. You can see Salesforce is in there. There's a number of them, and you can scroll down and see them all. And so this is what we would be buying if we bought this ETF. All these companies kind of averaged in a single stock. So I'm going to back out. Okay, let's scroll back up. Let's reset that filter. Let's take a look at another one. Let's suppose for a second that we were saying, actually, and you can't normally invest in a lot of these asset classes on your own. So ETFs are amazing that way. But let's suppose you're saying, I want to go look at a commodity, right? And let's scroll down at different types of commodities. I'm going to take us down to, let's do precious metals. So here we are, precious metals, and there's 16 different gold ETFs. This one right here, this is a very popular, common one. And it's the, if you had purchased this the year to date, it's a 26%. But buying this ETF is the equivalent of literally buying gold. It gives you the identical exposure. But this way you don't actually have to store it and have the physical items of gold, but you can get diversity where you're saying, I don't want to just be invested in stocks or bonds. I'd like to get some commodities in there. I'd like to own a little bit of gold, which can be protection against inflation, for example. Or if there's currency risk, gold is sometimes viewed as an alternative currency. So that's good for diversification purposes as well. If we scroll back up, we might say, what if someone says, okay, I want to invest in oil, like oil prices, right? This USO, this is a very popular oil ETF. You can see right here, oil prices are down. So these guys have just gotten hammered. So they've, since the beginning of the year, down 72% if you had invested in that particular ETF. That's just because oil's down. Not hard to imagine when there aren't many airlines running, and just in general, the economy is down. However, let's suppose that you can come down here to attributes, and there's more ways that you can kind of drill down. So let's suppose that you're saying, well, what if I was looking for something that was inverse? And inverse is another way of saying shorting the market. For those of you that know what that means, if you don't worry about it. But there's a ways to actually even short the market. So this one right here, this SCO, this is a fund that actually shorts oil. And so in this case here, they're up, almost 38% on the year because they're shorting oil. My purpose in showing you these demonstrations is that there's a lot of interesting ETFs, just over 2,300 in total. And it's a great way to diversify. And you can just explore and kind of play around here. But the idea is that you can get access to a lot of different sectors of the economy and different asset classes. And it's a very cost-efficient way to build out your portfolio and making sure that you're getting rid of that unsystematic risk. So let me just kind of summarize a bit. All of us are looking to save for retirement and for the future. And investing in the market is going to be a big part of that. You can make a lot of money in the market, but you can stand to lose your money. And we don't want that. So this all becomes about how can I reduce the risk and bring more certainty to my investments in my portfolio. And I'll bring that to our summary. First, risk is the chance that an investment's actual gains will differ from your expected outcome. Second, volatility is the most common measure of risk. It measures dispersion or uncertainty. Third, volatility stems from both unsystematic and systematic risk. Fourth, unsystematic risk can largely be eliminated through diversification. And systematic risk through good asset allocation, i.e. going through some of those different asset classes, that can also reduce some of your systematic risk as well. Four, I already said that one. Five, ETFs are a great vehicle to diversify. They're low cost, they're tax efficient, they don't have a lot of transaction costs because they're not churning. Six, ETFs provide access to a variety of asset classes beyond stocks like commodities, bonds, real estate, even currencies for effective asset allocation. And seventh, given a target return, ETFs can lower your overall risk and bring more certainty to your investment. And that, folks, is how, in my personal portfolio, I like to manage volatility and risk.